The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Happy Monday. We are live from Studio 2 at Bloomberg headquarters in New York. I'm Alex Thiel.
And I'm Sonali Basak, in for Romaine Bostic, and we are kicking you off to the closing bell here in the United States.
Thanks for joining us, by the way. You do the opening and the closing. This is good for you.
Long day. It's a round circle, kind of, sort of.
We're bookending it. We're bookending it. All right, here's where we are in the markets here. You got the S&P going up 0.3%, pretty much going nowhere fast. There's not a lot of movement or churn within the overall equity market, and the rest is kind of steady as she goes. Gold hitting another record high. How many record highs can you have? And the 210 spread continuing to disinvert. Now we're going to call it steepening. Now we're at 16 basis points. That Fed trade, that Fed-cutting trade, still playing out, Sonali.
And Fed speak is hitting the tape with Chicago Fed President Austin Goolsbee saying interest rates are hundreds of basis points above neutral and that rates need to drop significantly. And yields fall ahead of a lot of Treasury supply hitting the market this week. There's also Ed Yardeni is the latest to warn of an outright melt-up in stocks, concerned that the Fed could overheat the economy and create a bubble in the market.
I think by cutting rates by 50 basis points and by indicating that they want to do more, at least in some of the recent comments, they're risking overheating a warm economy.
Yardeni has an S&P target of 5,800, of course, a little bit higher than where we stand right now. There's, of course, Apollo versus Qualcomm. Some reports are saying that Apollo is offering to make a multi-billion-dollar investment in the struggling chip maker, while others say Qualcomm approached Intel about a potential deal. The stock, remember, is down over 20% since its disastrous earnings report in August, but we're going to get the latest, Alex.
All right, Sonali, well, let's take a look more about that market action, and that leads me to positioning. So I love looking at positioning because it kind of sets us up to where we may see the market reaction to certain data. So this is the E-mini S&P futures, non-commercial futures positioning, and we see we're really net short at this point. We're at the most net short that we've seen since earlier this year. It's been a good few months since we've been this net short. What's interesting about this is the same kind of data shows that for the Russell 2000, future positioning on the CFTC data hit a new post-COVID high. So that idea of that rotation going to go by small caps, going to go by mid caps, outperforming today, for example, whereas futures positioning for the S&P continues to go short. Is that the trade, Sonali, mid caps, small caps, or is it too early to really commit to that?
I love that positioning data. Shows us what's under the hood, even on an up day. We're going to kick things off with Sherry Paul. She's private wealth advisor and senior portfolio manager at Morgan Stanley Private Wealth Management. And the positioning data that Alex showed us that there's still a little fear under the surface. Are you hearing the same thing from your clients?
Yeah, but it's sort of misplaced fear, really due to geopolitics and uncertainty that people are feeling around the election. But my strong encouragement is we don't want to trade the politics, stay focused on the market data. And right now there's a good setup coming that we want to get people focused in terms of recalibrating their thinking. I'm going to steal that word from the Fed. They're thinking about how to set up portfolios right now.
You know, one way you could see it is that you had that 50 basis point rate cut, more are expected. Do you expect money to start flowing out of cash into equities at a greater rate? We've seen some of it already.
I would hope so. I mean, right now, you can move out of a declining rate environment in cash where you're guaranteeing yourself a pay cut into dividend-paying stocks where we're seeing cyclically, we should start to see dividend rates go higher. And if you're willing to own, cash positions, but you can wait it out based on your financial plan, you should definitely be stepping into this market.
So I guess where does that money, though, belong? There was a great piece that just hit the tape that talked about how money market funds are still inverted in terms of the short term and long term, right? Mm-hmm. So the incentive to actually want to put money to work in the long end just isn't there right now.
Yeah.
Where does that money belong and what's the trigger for it coming out?
Well, it definitely belongs in a longer time horizon than short term. So the first thing you'd have to do is recalibrate your time frame in terms of expected return. And right now, if you're coming out of cash, there's still opportunity in the intermediate part of the bond curve if you want to replicate that money, protect yourself from further cuts. We think there's another, half a point coming, maybe a full point next year. So there's still time to rate protect, a comparable investment. And then, frankly, if you take a look at, great opportunity within a dividend-paying sectors, again, that can stabilize cash flow and income in what will likely be a more volatile market. But volatility is not indicative of a poor market condition. Okay, it's just indicative of money coming in and out of the market, and we should see conditions improve into next year.
Is this the moment for mid caps?
Well, mid-caps typically perform well in a strengthening U.S. economy. Right now, the cost of capital just got whacked, in terms of it being less expensive. So I think that's where we're seeing the small and the mid-cap sort of improve. But it's a little bit too soon to tell. We've been selectively weighting into small and mid-cap over the past, 3 months or so. But right now, what we're doing is looking for that small cap return on a big cap balance sheet. And that's really where tech and innovation is occurring. So we're skewing, again, towards the large cap.
So what does that look like? If you get into small and mid cap selectively, we've seen some of that in this market. A lot of fear still out there, like you've been saying, around how much leverage still is in that system, right? So where do you look to get a return there that you feel safe enough to get into?
Well, I think you look like really in a limited basis and very selectively because the opportunity for a risk-adjusted return outside of small and mid-cap is still so much more compelling in the large cap space than why would you take on that excess risk for a comparable type return and without a dividend. And so, I think the case for small and mid still needs to be teased out a bit.
The other thing I'm very interested in is the fact that people are pouring into consumer discretionary stocks. Over a 5-day basis in the S&P 500, it's the best performer. And of course, there's single names. There's the likes of Nike with its new CEO announcement.
Yeah, but like Bed Bath, like what's up with that?
What's going on? And so do you think it's a time to bet on the consumer?
What's up with that?
That's a show I want to have at some point.
What's up? That would be a very good show for you.
What's up with that? Thank you.
I think that would be the name of your podcast. But what is up with that?
Well, look, it's a winners or become losers, losers become winners. Consumer discretionary, one of the worst performing sectors that participated the least in the beginning of the year and frankly last year too. And just to remind everybody too that 2 years ago, the market went into a profits recession while the U.S. economy did not. Okay, so the market's already reset itself. So it would make sense that, for contrarian money to be coming back into the worst performing, which is consumer discretionary, just on a valuation basis makes selective sense to your point.
How long does that trade have legs for? In that, what do you need to see before it's just kidding, that's a fake out, a la mid caps and small caps from the last year, and we just sort of dump out?
Well, I think to see small and mid caps really start to gain traction, we'd have to see the U.S. economy strengthen. Given the fact that
not getting worse isn't good enough.
Well, not getting worse, I don't think is good enough. No, and remember, we have to now start building portfolios on what will probably happen, not what possibly might happen. And we know that probably what's happening is rates are going lower. And the question is why? We're in a slowing U.S. economy, different than a recession, okay, not a contraction. So modifying and recalibrating portfolios around the understanding around that, I think, is crucial.
But do you also think that probably the labor market is weakening? And then why bet on the consumer in that environment?
Yeah, well, great question. Never bet against the U.S. consumer is, one of my sayings. We're in a 70% consumptive-based GDP, and so while the labor market is cooling, that's different than falling off a cliff, and we're still 20% below our average unemployment rate, which is typically 5%. So I think that there's still breadth for the consumer, and let's not forget about all the cash that's in money market accounts that could be coming into this market.
See, consumer discretionary. What's up with that? See,
what's up with it?
It's a really good show. What about utilities? They have really, reared up in the third quarter. The best performing stock, the third best performing stock in the S&P this year are both in the utility sector. Is that a growth play, defensive play, or dividend play?
Well, it's probably a little bit of both, but right now it's a little bit long in the tooth, right?
Okay.
And so it's very interest rate sensitive type of a trade versus, I would rather lean into discretionary stocks or frankly staples and healthcare, industrials, where we can quantify earnings and the potential for dividend increases based on the merits of the quality of the earnings and the balance sheet, not just necessarily based on interest rate trades.
I'm going to set Alex off with this question, I think. What's up with energy? Because
energy, what's up with that?
What's up with it? It's been the worst performing sector year to date in the S&P 500. You've seen a pretty significant bid in the last month, let's say. Is that a sustainable bid?
Well, energy, as a portfolio manager, energy for me has always been a political football it's very policy sensitive, very hard to quantify, so never is a meaningful part of a portfolio. It's less than 3 or 4% of the S&P, so it doesn't weigh on the total return of the S&P. Much better opportunities, I think, in selective tech and healthcare that define the underpinnings of this particular bull market, which is AI and this generational industrial revolution that's engineering profits reduction and productivity enhancement.
Yeah, and as a portfolio manager, it's like you can't own too much energy because it doesn't look great, so it gets a little tricky too. I would think.
I'd set you up.
Yeah, okay. Sherry, thanks a lot. It's been great to see you. Thanks for coming in. Sherry Paul, private wealth advisor and senior portfolio manager at Morgan Stanley Private Wealth Management. All right, coming up, the Fed's 50 basis point cut last week, leaving a big question mark for the state of American real estate. PGIM Real Estate co-CEO Cathy Marcus explains why there's been a psychological shift in the real estate market, even more pronounced by the Fed's latest move.
Plus, Novo Nordisk in the hot seat tomorrow. Senators are preparing to grill the pharma giant on its pricing practices for GLP drugs, Novo Nordisk, and Wegovy. We're going to dive into the revenue numbers behind the blockbuster drugs.
And with AI breaking America's energy bank, we're going to look at how companies are working with data centers to provide America the capabilities to continue to be a leader in the tech. All that and more coming up. This is The Close on Bloomberg. Today is officially the first day that Palantir is part of the S&P 500. You got shares rising over 2%, hitting a 52-week high. So Wall Street's scooping up these shares. CEO Alex Karp has a contested relationship with the same people boosting his stock. Bloomberg's Ed Ludlow breaks down Alex Karp Wall Street relationship and what it means for the data analytics giant. All right, Ed, what do you got?
Yeah, it's just a bizarre, at times entertaining, at times confusing story. But this is a stock that's up 5x since 2022. And actually, it's one where you even look at the short-term gains, year-to-date 120%. It had a gain greater than that in full year 23. And Alex Karp is at the center of this story, one of the founders, 2004. He has this very interesting class of shares that give him very superior voting rights. He's been combative with the traditional institutional investor base, and at the same time recognizes that the retail investor is so core to this name that on both the public and private sector sides is making a lot of gains in this AI world we're in. I think that's a pretty good summary.
That's a great summary. And we'll talk more about his personality in a minute there because, of course, it is fascinating. But another thing that's fascinating, Ed, is you started the day with Palantir down. Pre-market, it was down. It started the opening trades down, partially because of concerns about valuation starting to seep into the street's estimates here. But you will now see it up more than 2%. So it looks like there are some forces winning here in the narrative. Is it just that institutional adoption being available to them, or is it another narrative?
I don't know. Maybe they read Lizette Chapman's detailed Business Week story on their way to the trading floor this morning and had a change of heart. I think that the problem with Palantir is that there is kind of a circus around Alex Karp that distracts from the growth, right? They did have their first full year of profit in 2023. They continue to be profitable. They're at a kind of tipping point where historically a lot of the sales growth has come from public sector, including the military and defense and the Pentagon. Now the commercial business is starting to grow, and we know about the broader environment where corporate America is willing to spend on AI products. So, you can do the math on the stock's valuation, but I think most people are now starting to understand the story a little bit better. Because when I first started visiting Palantir a year ago, 2 years ago even, most people would turn around to you and say, I actually have no idea what Palantir does.
No, fair enough. And that's a good point. But it also makes it interesting, too, that you could just write it off and say, OK, well, they joined the S&P. We knew it was coming, but this is the first day of trading in the index. Yeah. Therefore, thus, the stock is up despite the downgrade over Raymond James. But then you look at Apple, and that stock had a gap down, which doesn't really make a lot of sense, because in theory, that was supposed to be the stock that all the index fund was going to have to buy as they rebalanced.
Right, triple witching. Yeah. And I think our colleague Lou Wang's been kind of digging into who the buyers and sellers are in this Apple market. Just really quickly on Palantir in the S&P 500, that's why in my preamble I kind of joked about the background story with Karp, the dual shares, class of shares, because they really wanted the S&P 500 inclusion for a long time. They made no secret of it, but it actually it's the change in sort of what am I trying to say? Eligibility rules.
There we go.
That has kind of allowed them to do it. I apologize. Because for a long time, profit was nowhere to be seen. The sort of founder control part of that story was an issue. As you know, the criteria are now different. They are eligible. And so it's been a long time coming. But I think from the market's perspective, they kind of expected it to happen anyway. Now it's happened. Here we are.
Ed, we thank you so much for all your coverage. Of course, that is co-host of Bloomberg Technology, Ed Ludlow. And it's interesting, Alex, you have to wonder, when I was looking back, you have Palantir, which has a lot of government defense contracts here, Intel as well. Up today based on all the deal rumors, but it had a much bigger jump, if you remember, when it confirmed its $3 billion worth of grants for Pentagon chips.
Yep.
So you have to wonder whether these tech stocks that have the government as their ultimate buyer being really the story underneath the surface.
Well, actually, I think that's a good point, because when you talk to a lot of economists about the difference with the U.S. economy and everything else, it's fiscal. And I'm not saying that's just in defense contracting, but in general, the amount of fiscal that they spend and how they pump in is the differentiator in terms of growth.
And, you know, for energy, it's drilled, baby, drill. From maybe AI, it's spend, baby, spend.
There's a line to get to drill, baby, drill. From that, we'll make it in the next hour. But
Okay,
there's a line.
Anyways, coming up, we're going to talk about General Motors because Bernstein is pumping the brakes. We're going to talk about that next up in Top Calls. We'll talk to the analyst telling investors to wait and see what GM has in the tank to deal with earnings headwinds. This is The Close on Bloomberg.
Time now for our top calls. A look at some of the big movers on the back of analyst recommendations. First up, we got Keurig Dr. Pepper raised to buy from neutral over at Citi. The firm says the U.S. coffee business has been at fault for the beverage company's recent underperformance, but they do expect volume improvement in the coffee unit later this year thanks to new brands and the K-Brew Plus Chill launch. Price target fizzles up. Sure. Price target moves up to about $43 from $36. That stock is up over 1% today. All right, next in line, you got Ulta Beauty downgraded to hold from buy over TD Cowen. Now, the analyst says there are a category leader, but it's just not enough in the face of a slowing industry and increasing competition. He says Ulta needs to invest in exclusives, brand incubation, and its in-store experience if it wants to sit pretty in this increasingly competitive space. Shares are down almost 2%. All right, finally, you got Microsoft clicked down to neutral from buy over at D.A. Davidson. Analyst Gil Luria says that the AI competition is heating up and the competitors are leaving Microsoft behind, resulting in a current premium valuation that is no longer justified. Shares down by about 0.3%. And those are some of our top calls. Shonali?
And another downgrade moving the markets today is on General Motors. Bernstein is cutting its outperform rating to market perform. The analysts there flagging earnings headwinds and telling investors to wait and see for more on GM's overall strategy. And the analyst behind that call now is here with us now, Daniel Roeska, managing director and senior analyst over at Bernstein. And if you think about the news that kind of hit the tape over this weekend, the idea of layoffs over at a certain plant that they have over in Kansas, I wonder if it's that or the downgrade alone or other headwinds that they're facing in terms of spend around electric vehicles that set the tone this morning. What do you think after talking to clients?
Yes, no, I think there are really 3 points, right? The stock has been up tremendously in the past 12 months, 85% up since last November. That's really strong. And now we're getting to see some headwinds in 25. The ramp up of electric vehicles costs a lot of money. That's moving into 25. We're seeing inventories spike up, which is indicating that price pressure is going to follow. And so that makes us worried about 25. And we've got a Capital Markets Day coming up on October 8th, where they're likely going to talk about their plans on EVs, on software, on robotaxis. And we're just worried that that means more capital spending.
Now, if you think that's going to be more capital spending, what does this mean for the layoff news in particular? Where do they have to spend their capital now to stave more layoffs of this type?
Well, the layoff is really a smaller piece in a bigger plan. I think the question is, how does GM and how do other OEMs really transition their manufacturing base in the U.S. from combustion engine to what will be electric vehicle at some point in the future? And the real challenge for these companies right now is figuring out the speed of that transition, also given what's going to happen in November.
What's inventory like right now for these guys?
Inventory is up. We're about 80 days of sale right now. And
how does that compare to, say, we were a few years ago?
Typical for the industry would be like 60.
Okay.
So when we're at 60 days of sale, that's when incentive starts coming back. You've seen that discounts for GM have been up from about 0% 2 years ago, back up to 7-8% now and rising. We've got some people that are worse, but GM is kind of held quite well, and August was the first data point where it got worse and ticked up.
When do you think we can say that these companies have right-sized enough to still be in the EV market, but yet they redeployed the right kind of cash and capital to its current ICEs or hybrids, et cetera? When do we know if they found the right balance and we're good?
I'm not sure, Alex, that I can answer that question.
His face has went through many stages when I asked this question.
But think about it this way, right? We don't know the speed at which the market is converting to EVs.
Right.
And so you have to put an assumption saying, look, we're going to push on EVs this hard. The difficulty for GM specifically is that they're lacking the bridge technology. Everybody else in the US is using plug-in hybrids, which consumers like a lot more than EVs right now, but that technology is not really present in GM's US lineup. And so that's going to be a big question for the Capital Markets Day if they can push that in.
Well, to that point that you've been making, I think a lot of people have known that this transition to EVs is going to be large, costly, but we're seeing it happen in real time. And every time we see how costly it is, you see a different car maker take a hit from it. For GM in particular, do we know exactly how much it's going to cost them when you don't really know how long that horizon would be?
It's a difficult question for two things, right? For one, it depends on GM's decision. How fast do they want to push electric vehicles? Right now, they're making losses on every electric vehicle they sell. And so the more of them they sell to comply with regulations, to comply with the EPA, the more losses they make, right? But they have to get through that valley at some point to gain the volumes to really get to a profitable landscape.
You think about how long it's taken them to kind of make this kind of robo-taxi transition. We're about to get a taste of what that looks like. How do you feel about the investment that they're making in that area?
I think Cruise needs more money, right? It looks like it's a good technology, but they need to find a partner to invest in the business. I think GM shareholders will be quite disappointed if they were using GM shareholders' cash to build all those robo-taxis. And I think that's another big question for the Capital Markets Day that's coming up.
We saw last week Mercedes take a hit. They had to sort of reshuffle their expectations for sales. A large part of that is China and the luxury growth market there. GM doesn't have that risk in essence. So is that a benefit, or do they just have like a different boatload of risks?
It's a different boatload. So GM has a China risk, and their China business is doing terrible. Compared to the North American business, it's peanuts, right? North America about 10 billion in EBIT, China about minus 500, but that's still there. But the real challenge for GM is figuring out how to transition the US market and the speed at which that will be going.
And do you think that they figured that out yet?
I don't think anybody has.
Okay.
And the difficulty for them is that their production setup, banking on the Ultium platform for EVs, is less flexible than, let's say, a Ford who have plug-in hybrids, or a Stellantis who can actually switch between drivetrains on the same platform.
No, it's a fair point. And also Toyota too, right? Or Hyundai, they make a lot of the hybrids as well. All right, Daniel, thanks a lot. Thanks for coming in. We appreciate it. Daniel Roeska over at Bernstein on the issues facing GM as we go to that Capital Markets Day. You just got a new car.
I did.
But it was not a hybrid.
Not a hybrid. I can't afford one yet.
Are you getting a BMW?
Yes, but it is a two-door only.
Oh, well, I mean, what else? All right, coming up. Now that the Fed has done that big 50 basis point rate cut, Cathy Marcus, co-CEO of PGIM Real Estate, will be joining us and how it impacts her business. This is Bloomberg.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that.
And that was Federal Reserve Bank of Chicago President here, Austin Goolsbee, discussing the potential future policy path for the Fed. It's about 3:30 in New York. This is the countdown to the close. I'm Shonali Bassick.
And I'm Alex Steele. He was pretty aggressive in talking about how we're hundreds of basis points above neutral, to the point that I found it interesting because no one really knows where neutral is, the real neutral rate, right? And there are a lot of questions as to, is it as low as some think, or does it need to go higher, in which case we're not as restrictive?
Pretty massive delta. We're hearing from our readers, viewers, listeners here from anywhere from 3.5% to 4.5%, but higher for longer is still the case. But at least 110 basis points worth of rate cuts priced in still this year alone.
Right, exactly. So then we're going to get that 50. Is that we're kind of looking at? So our next guest says that the recent Fed cuts further supports her case that the U.S. real estate market has bottomed. There's nowhere to go but up from here. It's a fair point. Here in the studio with more on this is Cathy Marcus, co-CEO and Global Chief Operating Officer over at PGIM Real Estate. So we get the 50 basis point cuts. We're on the trajectory. We don't know where we end up, but we're going there. What's the immediate impact in your space?
Well, it's interesting because as a private illiquid asset class, there isn't the same level of immediate impact that you might see in a public asset. But it's generally, obviously, a very good thing and very supportive of real estate. And if you couple the lower interest rates with the fact that we definitely believe that we are at the end of this very gradual repricing that we've had in the private real estate markets, it really feels like a very, very attractive entry point. And it's a window that's not going to stay open forever.
Where is the attractive entry point, and what do you still not want to touch?
Well, I think the very obvious headline grabber, of course, is office is probably not at the top of our shopping list at this point, although I do believe that a lot of the hype has been quite overblown around office. At the end of the day, office is not going to be a needle mover going forward, in that right now it represents only about 4% of the investable universe of the public real estate markets and just under 15% of the private real estate markets. So it's really just not going to have a lot of impact. But where we do see the opportunity for great income growth, durable cash flows, and capital appreciation are in things like the living sectors, industrial real estate or logistics, and of course data centers.
What about offices that are no longer offices? There's a story on Bloomberg right now about how the old Goldman headquarters in the financial district, where many financial companies no longer are, were then turned into $4,000 a month apartments. Are those kind of opportunities going to fly off the shelf, you think?
I wouldn't say fly off the shelf. I think that would be just like a wonderful dream if all of the office that doesn't work anymore could solve our housing issues in the United States and around the world. But unfortunately, that is really going to be very selective. And actually, Lower Manhattan is really one of the best places to do that, because you have these smaller floor plate buildings that were built a long time ago on very small lots. So if you think about a really large office building with large floor plates, you would have very strangely situated apartments if you wanted to have any windows, because you'd have this whole giant area in the middle. And so that really becomes the problem is, do you have the plumbing? Do you have enough windows? How can you add natural light and not have an apartment that looks like a bowling alley? And so there definitely will be some opportunities, and actually those will probably be some great apartments when it works, but it's not a scalable solution.
What do you see as a bigger opportunity here as an investor? There's clearly an affordability crisis in housing in the United States. Shelter costs have been high. People want more supply. But as an investor, do you see more opportunity in apartment buildings, in single family housing? Where is the best opportunity?
Really, the living sectors broadly are great. And one of our global themes from an investment perspective is around demographics. And you think about demographics really lending itself across the spectrum of your lifetime. You have student housing, you have multifamily apartments, you have seniors housing, you have manufactured housing. So you, across the affordability spectrum and across kind of your lifespan, right? There's so many opportunities because there's undersupply in pretty much every single one of those sectors.
What are valuations like there? Because usually when I talk to someone deep in real estate, it's always going to be logistics, data centers, and senior housing, or student housing, or both. So what are valuations? Are all the money in that area? How do you differentiate?
Really, first of all, values have come down tremendously in commercial real estate, which is
across the board.
Across the board. Okay, so across the board, call it 20 to 25% down, but with office down 40 to 50%. So you have some sectors like manufactured housing in the private markets hasn't gone down at all. Seniors housing had a really tough run with COVID, and then had a really tough time with inflation, because you think about labor inflation, very, very labor intensive operations, food inflation. We serve 3 meals a day to all of our residents. So it really has had a tough run, but we're seeing really markedly improved operations in all of our projects. So from a valuation perspective, we really think the living sectors are broadly valued very fairly right now, very attractively.
Logistics, is that like warehousing for Amazon kind of logistics, or is that data center logistics stuff? Really, we think of those two things separately. Okay. So if you start with warehouses, industrial, it is a lot about Amazon and e-commerce and the rebuilding of supply chains, and it's something that we're still, very, very bullish about globally, particularly in very infill locations with
high population centers. Data centers, different than warehouses, although from the outside they might look a little bit similar, much more expensive to build for sure. So data centers, the projections right now are for about a little over 20% compounded annual growth in demand for capacity in data centers over the next 5 years. So we were a very early mover from an institutional perspective in investing in data centers and started about 11 years ago. And at that point, our investment thesis was really about Netflix. And then it became about remote work and all of our video conferences that we're having all the time. And now it's about the AI revolution. So if you really think about a data center and AI, a data center is essentially like a digital classroom for AI. All of the AI is being trained in data centers.
So there has been so much money, to Alex's point, flowing into data centers recently. 11 years ago, you were there before many of these other newcomers were there, frankly. Yes. So how has that not made the valuation much more difficult in that area, especially because there are a lot of people who kind of worry about the energy needs around those data centers and the new infrastructure that it'll take to keep building them?
For sure. And if you think about, when I think about the data centers that we invested in 11 years ago, they were very, very different. They had much lower energy usage, much lower energy capacity, and they were for a totally different purpose. And they were not as large, they were not as expensive. And right now, the data centers that are being built are extremely expensive. And you can't do what needs to be done in this new 2.0 data center, which we call hyperscale. You can't do that in an old data center. It just doesn't work. So it's really about kind of building this new inventory that's going to be needed. And it's, there's tremendous demand.
Cathy, we have to leave it there. It's such a pleasant conversation. Nice to talk to you. A very hot sector that people are looking at, and of course, it impacts all parts of the economy. That is Cathy Marcus. She is the co-CEO of PGIM Real Estate. And we're going to talk about Intel getting a vote of confidence in the market with the multi-million-dollar investment plan from Apollo for the chipmaker's turnaround strategy. This also comes as rival Qualcomm also reportedly eyeing a takeover. We're going to talk about that now with Stacy Rasgon, Senior Analyst of U.S. Semiconductors at Berstein Research. He has a market perform rating on Intel. When we think about kind of what's possible for Intel, you have to imagine that the market this morning is reacting from at least a multitude of choices here. But the question, Stacy, is which choice is best?
So let's talk about both of them. So there's two pieces of news. One was that came out on Friday afternoon that suggested that Qualcomm might have made an overture to them for an acquisition. And the other is the news flow this morning about a potential investment by Apollo. In terms of the first, I'll be honest. I understand the diversification, thesis for Qualcomm to be interested maybe in pieces of Intel. They do PCs and data center and other things that don't really overlap but would be complementary. But at the same time, I find it very difficult to see a deal like this working if it includes Intel's manufacturing assets, if it includes the fabs, which are losing a lot of money and require a lot of CapEx. I don't really see how the financials of the deal, both from an earnings accretion as well as a leverage point of view, can work with the fabs. I mean, and I don't think it's really possible or tenable to split up the fabs at this point either. Intel has talked about doing it at some point maybe. But right now, those fabs cannot stand on their own. They're losing billions of dollars a year. Intel's the only customer. I don't think you can sell them to another operator like a TSMC or something. I don't think they want to run them. And while hypothetically, I suppose you could just scrap them and sell the tools for whatever they're worth and just try to outsource all of your manufacturing, I don't think that's really politically viable at this point, given all of the efforts by the government to try to build up a U.S. Chip manufacturing. So I'll be honest, from Qualcomm's standpoint, I would rather not see them do something like this, especially one that goes with the fabs. I just think the risks are probably too high and the uncertainty too big to justify it. Now, regarding the Apollo investment, so again, nothing's been announced. We saw this morning, though, that the news is that they may be considering a $5 billion, I think it's an equity-like investment, whatever that means. Some people are reading this as a vote of confidence, and I guess so. And I mean, look, Intel already has a relationship with Apollo. They've already sold 50% of their Ireland fab to Apollo for $11 billion. I will be honest, though. I'm of the view that you don't really want to take private equity money unless you really have to.
Mm-hmm.
Like
hey,
those
Stacey?
guys don't work for free.
Stacey, do they really have to, though? It sounds like we're
I don't
getting
think
there.
so. So from a cash standpoint, I don't think so. Maybe I'm wrong, but like I don't think that Intel is desperate for cash. If you add, because they're taking actions, if you add up the capex cuts and the opex cuts, the suspended dividend, the government subsidies and CHIPS Act money, and then the private equity money that they've already gotten or are already getting, the Apollo money, as well as they sold half of their Arizona fab to Brookfield. If you add all of that up, it's like $40 billion of incremental cash that should come onto the balance sheet in 2024 and 2025. I think that gives them enough runway. I don't think that they're desperate to like sell things in a fire sale or whatever. And so I don't think they have to take $5 billion in Apollo money. Might they choose to? Sure. I'm not sure it's the right. Like I said, I'm of the view that you probably don't want to take private equity money if you don't have to.
To that end, how important here is government money? Because if you think about the way that the stock has reacted, the biggest reaction was perhaps to the news that they had on the Pentagon CHIPS grant. And as they transition here, how reliant will they be on government money essentially to get through the storm that they've been in?
Yeah, so there was the DoD thing, the extra $3 billion in grants, but they also made the Amazon announcement that same day too. So it's hard to know which it was running on. The government funds are sizable, but they're actually just a fraction of what's going on. So they're getting it's $8.5 billion in CHIPS Act grants and maybe another $3 billion from the DoD stuff. And remember, these are milestone based. They don't get a check for $8.5 billion. They have to start building the projects, and as those projects build out over time, as they hit the individual milestones, they get the money. So they need those. But at the same time, they're getting, between the Brookfield and the Apollo deals for the fabs, that's almost $25 billion. And they're still spending, $13 billion of their own money. I think their net capex next year is $13 billion. Plus other funds they may be getting in other areas. So the CHIPS Act money is, and there's also the tax credit, by the way, which is just as important, if not even more important than the grants.
Right.
So I think the CHIPS Act money is important, but it's only a piece of like the broader puzzle of everything that they need.
So, Stacey, have they stemmed the bleeding then for now? All that announcement, plus the AWS stuff, plus the restructuring, et cetera, have they stemmed the bleeding?
I think from a cash standpoint, I hope so.
Fair enough.
Things can always get worse. I mean, we'll see. But I mean, the core business is already pretty bad. We'll see what happens there as we go forward. But I don't think they're in danger at this point of like running out of money. And we've written about this. I think the phrasing I used was I think they'll live. I don't know what kind of a life it'll be, but I think they'll live.
How much does Intel have to catch up with the likes of a TSMC to be successful at the end of the day, especially when you have so many global investors who will say, well, okay, TSMC is doing this more efficiently.
Yeah, and they are. And actually, TSMC is also building here in the U.S., and they looks like they're operational already. No, it's a huge piece of Intel strategy, right? Pat Gelsinger, the CEO, talks a lot about their 5 nodes in 4 years, and they're pushing on their next generation process node. It's a node that's called 18A that should be roughly equivalent to what TSMC calls 2 nanometer. Intel thinks it's better. I guess we'll see. That products for some of their internal products are supposed to be coming to market on that process sometime next year. I would define this though. I mean, they need to catch up and ideally surpass TSMC, although I would say just catching up to them is probably necessary but not sufficient. They probably do need to be better over time, both to get their own internal cost structure in a good place so their margins in finances and operations can get better, but also so that they can give customers a reason to come so they can attract that external foundry volume that is what they need in order to scale their manufacturing business to a point where it's profitable.
Hey, Stacy, really appreciate you jumping on with us. Got to leave it there. Stacy Rasgon over at Bernstein Research. Thank you very much. Intel stock trading up by over 3%. Last time we talked to Tracy Shinali, it was very much like they have to get here. But how they get to here, like there's a big question mark on how they do that and how they do that profitably and how they actually get there and how long it winds up taking. And it doesn't seem like this necessarily gives us any clarity on that part.
I think what we're starting to get little bits of, hints of is who's going to help them. Because if Apollo might come in with an investment, for example, or even talking about it, it really raises the question, will other private asset managers also think about similar types of investments to be part of this long-term story? Will their stockholders also accept it? Someone like Stacy does not.
Yeah, he's like, don't take it unless you absolutely need to. Maybe they don't need to. Stock up today. All right, we're about 15 minutes away from the closing bell. S&P up 0.2%. We'll count you down with Paul Christopher, head of global investment strategy at Wells Fargo. This is Bloomberg.
We're less than 10 minutes away from the closing bells. And Alex, it has been an update for the most part.
I know, an update, but like an uninspired update. I feel like, are we waiting for some kind of next catalyst? And do we have to wait for the jobs report, or is it the inflation data we're going to get on Friday? S&P up, but mid-caps outperforming. Discretionary, as you point out, consumer discretionary outperforming within the S&P. And the equal weighted also outperforming. So that rotation story continues to happen. But kind of what is that next catalyst?
It's absolutely fascinating. We have a lot of economic data this week, including a lot of consumer sentiment data. So let's see how the story goes into the week's trade. For more market analysis, we're going to bring in Paul Christopher. He is head of global investment strategy at Wells Fargo Investment Institute. And at the end of the day, you look at this kind of rally we've had pretty much since the Fed cut interest rates last week with that 50 basis point rate cut. Do you think that this is sustainable given all the data that we have ahead?
Well, not without some bumps along the way. I mean, you did mention consumer sentiment. That's been in the dumps, and you can't expect 50 basis point cut to be like magic pixie dust. It doesn't work overnight. So there's likely to be some time, maybe a couple of months worth of still struggling consumer, small business, and employment data. And markets are going to have to figure out whether that 50 basis points came too late or whether it was just in time. And as you get some of these numbers come in and they disappoint, there is potential for markets to pull back.
Would another, sorry, Alex.
Sorry, that was my fault.
To that end, would another 50 basis point rate cut help out?
Oh, absolutely, but it's just going to take time. Look, the weak segments of the economy, because of this, let's put it this way, the segments that have been having to hold their breath underwater now for more than 2 years have been consumers and small businesses. They're not going to be able to respond right away to lower interest rates, although mortgage rates have come down a little bit. But it's going to take some time, so probably a couple of months. In the meantime, you've got the elections, you've got liquidity kind of coming off in bank reserves. So there's some potential here for some bumps along the way.
Well, Paul, but I was going to jump in because you said that the consumer is weak, but a lot of the data that we see continues to be strong. Sentiment data from the UMich, actual spending seems to be holding up, real income on the same way. So where's the discrepancy?
So when you look at let's say the University of Michigan data, for example, if you look at the sentiment data currently, it doesn't look as good as the data for the expectations. And so as you look ahead, that means that consumers are still under a little bit of stress today, but they are expecting things to get better over the next 6 months. That makes a lot of sense to us. And then again, interest rates aren't going to solve that overnight. So you're going to have some bumps along the way. That's why our focus on guidance is really still quality based. Right? We like the U.S. better than international. We like large caps better than mids and smalls. But we're trying to position ourselves, too, to be ready for that upturn that we get in the next 3 to 6 months.
So where do you find that then, Paul?
Well, what we're looking at right now is, first of all, we stop being underweight small caps. They should be one of the first ones out of the gate and in a big way as interest rate cuts become more entrenched and more actionable by smaller businesses. So we've gone back up to strategic weight on small caps, just getting positioned here for a much better rally next year. Same thing with cyclicals. So think industrials, materials, energy, financials. We're positioned in all of those to take advantage of the turn coming out in 2025. All look pretty cheap, good values right now.
I guess I want to hop on the same train Alex has been on here and ask him a little more about the consumer, because it has been a very popular trade, particularly since the Federal Reserve did cut rates. Is there a chance you miss the train if you don't get on it now, given that there has been so much exuberance and given the data has been showing resilience?
Yeah, so we've seen resilience from the consumer for, oh goodness, more than 2 years now, and a lot of that resilience comes from the upper income quintiles. The people in the lower couple or maybe even 3 income quintiles, they're struggling quite a bit. And as they continue to struggle, small businesses will struggle, and that means employment's going to struggle, so the whole economy is going to struggle. It's not really a case that the upper income individuals can carry the economy by themselves. They're also starting to shop down at the big box stores. So we think the consumer is more strained than it may appear, and we need some time maybe for them to recover fully. That's not going to happen on the first or even the second rate cut.
Paul, to that end, when you look at market pricing, you see the market pricing in almost 2 full percentage points worth, or 2 full percentage points, right, worth of rate cuts. I can't believe I'm even saying that out loud sometimes. Worth of rate cuts into the end of next year. Is that a view that we're that far above neutral, or is that a view that the economy could get a lot worse from here?
It's mainly a view, I think, I don't mean to parse words or anything, but it might be more a view that neutral is about 2 percentage points lower than where we are right now. The rates have been at this level, 5.5 for some time, and neutral as the economy slows, and importantly, inflation has come down. That makes neutral a little bit lower.
So that very much echoes what Goolsby was saying earlier, that we need those big rate cuts because we're hundreds of basis points above neutral at the end of the day. What do you were mentioning yes. Mid and small caps, like you want to be testing the waters with that. What about other cyclicals, large cap cyclicals?
Yeah, so we like as I mentioned, we like industrials, materials, energy and financials. We've been underweight consumer discretionary. We'd like to see a little bit more evidence that the consumer's really ready to rebound here. If you look at credit card delinquencies, for example, those are very high still. So again, you need those interest rates to come down a little bit more, need wages to continue to grow so that people have cash to spend. We think that will be another one to get into. It's just not our first pick right now at the moment. But we think that's what will happen. You want to get on that train now while the valuations are good, but be a little bit selective. Again, leave off the discretionary, maybe focus on some of those picks and shovels sorts of sectors.
And then you mentioned financials, though, because they might be exposed to the same kind of headwinds as the consumer, for example, but you do the large guys and not the regionals?
Yeah, we'd start with the full basket of financials here. The fact is that the steepening in the yield curve has been mainly from the short end of the curve. The short end has come down very dramatically. That's sort of what we call bull steepening, is really good for financials. As we get into more growth, then the longer end of the curve starts to come back up, and it maybe we'll take a pass later. But for right now, we like financials.
All right, Paul, thanks a lot. Really appreciate it. Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute, joining us there. Looking at market, Shanali, where the S&P is up 0.3%, the Dow's up 0.2%, and the Nasdaq up 0.1. It's not that exciting.
It's incredible. Even though you see this bull steepening, and it's at the most extreme since it's been in years, you saw every bank except 4 banks in the KBW Bank Index down on the day. So that steepening trade into the financials isn't materializing yet, Alex.
Which is why it's going to be interesting when we get earnings, right? It's coming a couple weeks when we'll start to have it at JP Morgan. It's their outlook really about the loans that they're going to see, right, and the demand for that versus how much they can make on them.
You're scaring me. My alarm is already on
so sorry.
For 3 a.m. those days.
Oh, yes, there are. My Marcus high yield savings account has only come down once, though.
Yeah, that's true.
When they come down more, then we'll see. All right, we're moving you closer to the closing bell. We got full market coverage right here on Bloomberg on this Monday.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And we're about 2 minutes away from the end of the trading day. Alex Thiel here with Shanali Bassick in for Romaine Bostic, here to help us go through the closing bell. We got 2 global simulcast, Carol Massar and Stephen Carroll. They sent him over from London because that's how awesome he is, in for Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Carol.
You guys have worked together, haven't you?
Yeah, we did a show once. It was great. She never invited me back afterwards. So.
Wait, that's not fair. They tell me what to do.
This is the first time we're meeting on air. Hello and welcome.
We're in the same building this time. You know, this is much easier than doing it between London and New York.
It's amazing what we can do. Having said that, it does feel like you guys a quiet day today, and maybe we're just all exhausted from all the news last week. I'm already thinking about the inflation print that we get here in the U.S. later in the week, Stephen.
Yeah, I mean, hey, look, if ever we think that we're over talking about central banks, there's something else comes up, and we're looking at a PCE, of course, later this week as well. We did have some PMIs out earlier today for the U.S. showing a slight slowdown, but still an expansion territory. So the next focus will be core PCE.
I've also been interested in the steady climb in the tech and AI stocks as well. For all those valuation concerns, you have a market that's shaking it off, along with all the worries along with it.
Yep, and also if you take a look at the divergence of the different sectors, for example, we were talking earlier about how you had net short future positioning within the S&P, with the S&P mini futures, right? And you can see also on the Russell, on the other hand, you have super solid positioning for that. And I should point out the Russell's down 0.3%, outperforming mid caps, guys. Very interesting when you take a look at that market. The VIX, though, going nowhere as we head into these closing bells here. There you go. We're looking at a VIX at 15. Nothing to write home about, as Carol was just saying. The S&P, we're settling out here, but closing up by about 0.3% around the highs of the session. The Nasdaq up by 0.1, and the Dow up by 0.1%. Carol.
All right, so maybe this will excite you a little bit more. If I look at the S&P 500, most names in the index are actually higher today. 363 to the upside, 138 losing ground, and Shanali 2 unchanged.
I want to look at some of the sectors as well, what's been moving under the surface. We, of course, had very little red today on a green day. We've had healthcare, communication services, and information technology lower on the day. But we did have a firm bid in energy and consumer discretionary. These have been laggards on the year generally. But, of course, resuming that bid now, real estate as well, utilities. These have become the real rotation trades of the moment, Carol.
Yeah, I'm already thinking Christmas with that chart. That's the only thing I can do when I look at the colors there. All right, let's go to some of the individual. It's just around the corner.
I know. I was like, you want to shop right now, don't you? Is that what's happening in your brain?
I kind of do. All right, let's get to some of the individual gainers. Tesla, guys, check it out. It's the number one gainer in the S&P 500, top in also the Nasdaq 100, one of the biggest gainers there. So up 5% in the trade. Shares reaching their highest level in about 2 months. Barclays coming out, analysts saying that they expect third quarter deliveries to top consensus estimates, which could drive continued stock strength. So we definitely saw outperformance in Tesla today. Intel, I'm sure you guys have talked about it. I know we did. It's a top gainer in the Nasdaq 100. Apollo Global Management said to be offering a multi-billion-dollar investment in Intel, according to those familiar. And then you still have, remember, late Friday before the close, a report from the Wall Street Journal saying that maybe Qualcomm was interested in a potential takeover. So Intel continuing to be, it seems, certainly an interested target, or at least interested by some other folks. And Intel shares up about 3.3%. So we'll see where that one goes. And here's for something a little bit different. It's a biotech, Biohaven, up about 14%. It's a $4.2 billion market cap. It's experimental drugs slowing the progress of a rare nerve disease in a study which the company will use to seek U.S. approval later this year. So, Stephen, we saw investors moving into that one.
Yeah, we did. And look, hey, I've got the flip side of your Intel story. I've got Qualcomm for you as well. Shares down 1.7%, 1.75% there at the close. So obviously the fact that Apollo's getting interested in Intel means that if you're thinking about what Qualcomm might do, investors shying away a little bit from that one. Looking at the comments from Melius analyst Ben Wrightsey's there talking about acquiring Intel would be a mouthful for Qualcomm, and Qualcomm made a living as a fabulous chip innovator with a pretty simple story. So this would be moving into a much more complex world if they were to move in on Intel. Of course, antitrust concerns around that deal as well, which is something that should be very interesting to keep a focus on. Elsewhere, I'm looking at General Motors as well. Shares there down 1.7% at the close. We had seen Bernstein cut the recommendation on the automaker market from outperform. I'll get there in the end, saying the data suggests there could be rising earnings.
Hard for all of us.
We're all mundane. We're mundane hard
today. It's like
today.
10 o'clock where he's from right now.
Yeah, exactly. Right. Yeah, I've been awake for about 3 days. We'll figure it out eventually. We had that news over the weekend as well about GM starting to temporarily lay off 2/3 of the workers at the Fairfax factory in Kansas as well. That's as they begin production of the new Chevrolet Bolt model. So that's one other share that we've been looking at too. And American Airlines, which was down a little bit earlier, but just towards the close has managed to rally slightly, finishing down 0.3% as well. We've been talking about the Boeing news around the union deal there, and actually American Airlines one of the transport unions there looking for contract approval for a contract extension, which would be double-digit raises for workers at American Airlines. This would be fleet service workers, ground mechanics, and other personnel. Remember, American Airlines did deal with flight attendants just a couple of weeks ago, getting raises of as much as 20% at a cost of $4.2 billion. So that's in focus there as well. American Airlines down 0.3 at the close.
And of course, we're watching Boeing and how conversations are going on there. All right, guys, quick mention here. S&P closes a record, 40th record high this year. Let's say it again. 40th record high this year.
Stunning.
Absolutely no news.
It's just for me.
It's just for you. Yeah. I was actually looking. I was like, when was the FTSE's last record high? Because it feels like this is not something that you would talk about every day, Stephen Carroll.
I mean, the thing is that I'm practically gone to bed by the time the FTSE closes. But yeah, look, the FTSE was not having a great year. It has been a few months now since the election. But yeah, it's true that we're a bit far away from this 40 records.
Yeah, just a little bit. All right, we were looking at the bond market there. It's just worth touching on really quickly. Not a lot happened, but that curve continues to steepen, guys. It was really about the front end. Now maybe it's about the back end selling off a little bit, and we get $183 billion worth of supply coming on over the next 3 days. So that'll be interesting to see the takedown, but that's gone pretty well so far.
I I can't believe the 40th record in the S&P. Sorry, that just seems like a lot. Wow. All right, so let's get to something that we've all probably been measured at some point for our BMI, our body mass index, which is a relationship of our height and weight. And it's often used to say, are we healthy? Do we have a healthy weight? Are we overweight? Are we obese? Kind of put us into a clarification, if you will, or classification. Well, the Wall Street Journal out with a story, and doctors are looking at it and apparently saying that it's flawed. They say it doesn't distinguish between a couple of different types of fat, and it doesn't identify where the fat is located. And Stephen, all of this is really important to really figure out if you're going to have health problems going forward.
But also it's key to whether or not you get access to GLP-1 drugs as well. So this is something that's a very market-moving story as well. I mean, BMI originated in the 1800s. So, I mean, you could do with an update, I'd say, it'd be fair to say as well. And look, many doctors have been out there talking about how there are better measurements that you can use things like, you know, a ratio of waist to hip circumference is one way that could be used as an alternative as well. There's better calculations for metabolic health as well. Essentially, this was designed with a European man in mind. So as a result, it is very much out of date when looking at a global world.
It's 1800s, right? It's almost like some measurement.
Wait, so, but if we go by this, does that mean that America's like more overweight or less underweight?
Well, they'd have to decide how they're going to measure by it instead. And I think that would be the question for next.
Well, I think it's interesting also because you have the testimonials that you're hearing from the GLP drug maker here. And I think what's interesting about this also, this is kind of wonky, but if you think about what's going on in the drug industry, you have to think about how to pay for it, what the costs are, and what the insurance looks like. And this all comes with the overlay of that FTC crackdown on pharmacy benefit managers. Now, they're looking at insulin, but of course, you have to wonder how the rollover applies to GLP-1 over time. And I do think that the definitions ultimately play in at the end of the day, doesn't it?
You stunned us to silence because that was so smart for 406. Let's go to the other chat, shall we?
Okay, we shall.
This is Shonali's favorite, and she's the guest host, so let's do that to her right now. So apparently, the old Goldman Sachs building down on Wall Street was converted into apartments, and you can get one for like $4,000. And I find this so interesting because there was, I think, in like a clock tower somewhere in Brooklyn, and I desperately wanted to live there, but it was 3 bedrooms and no windows. And my husband's like, you cannot buy an apartment with no windows.
Well, he's right, first of all.
Yes, he was right. Just don't tell him I said that.
You would be so depressed. But also, you really have to go to lengths to refurbish these buildings, don't you guys?
Yeah, it can be really tough, right? We talk about this all the time, right? What you have to do for office buildings. Although I'm looking at pictures and I'm like, sign me up because it looks
good.
Well,
and is there nostalgia value?
You put a pool on the top of a building and like you're golden, like number one.
South Street Seaport is getting very cool. There's like a concert venue down there. So the whole area is being refurbished, let alone finally apartments. $4,000 a month in New York these days.
Well, unless it's like a studio. But you know what's interesting? I think it's like the width of the building. So the fatter your building is, the harder it is to convert because then you're like left with all this dead space. But if it's a skinnier building where some of those old buildings down there are, perfect for conversion.
Like, what do you do with the trading floor, right? Like, you know, we talk about open concept, love it, but that's really open concept.
That's your gym. And your, you know, lounge concierge baby stroller thingamajig.
Sounds like you're interested. Sounds like you're interested. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. We will see you again, same time, same place tomorrow.
All right, coming up, you got senators preparing to grill Novo Nordisk on how it goes about pricing its GLP-1 drugs. We're going to look into what should happen as the government puts price cap on the medications. Also, what Novo Nordisk wants to tell the government. This is The Close on Bloomberg. Welcome back to The Close. I'm Alex Steele.
And I'm Shonali Basak.
All right, let's take a look at some of the biggest movers because what 40th record high for the S&P?
It was incredible to watch, even though not that much happened.
Right, that's the crazy part.
We are higher, even though, you know, what's funny about this, yields from the beginning of last week have not changed that much.
Right.
So it's hard to blame this on interest rates.
Right, but the curve is a little bit steeper as well, and all the like. Individually, there were some individual stocks we don't want to focus on here, and Intel is one of them, that stock ending higher on the day. Of course, that news that maybe Apollo will be investing a few $1 billion into the company, but as Stacy Rasgon said over at Bernstein, mean, don't take private equity money unless you absolutely have to. The other stock I want to hit on here, and I appreciate this is an ADR, but go with me on this, is Kering. So Kering and LVMH were downgraded to neutral over Bank of America amid worries over a prolonged slowdown in the luxury goods sector. And we all know how much that has to do with China. China PBOC cut rates yesterday. They're going to make an announcement with something tomorrow. The hope is that there'll be a lot of stimulus coming from China that will help the consumer. But we heard the same thing from Mercedes, for example. They're really struggling as well, those luxury players getting hit. All right, our top story this hour are GLP-1s and the pricing backlash. Novo Nordisk's CEO is heading to Capitol Hill tomorrow to face a hearing led by Senator Bernie Sanders. The company is facing pressure to make its drug more affordable. Sanders says the drug could be profitably produced for less than $100 a month. That's almost $1,000 less than its list price. Novo says it's the middlemen that are the problem. And this is just the latest headwind for Novo as competition ramps up with new weight loss shots as well as pills. And Novo Nordisk has been raking in more than $50 billion from selling popular GLP-1 drugs, Ozempic and Wegovy. And now they want to spread the wealth. Bernie Sanders, of course, leading that move. All right, let's get more on this with Madison. There we go. Come on, prompter. Madison Muller. I was so close. I knew it was an M&M. Bloomberg News healthcare reporter. Madison, we know now what the CEO is going to say. What did we learn?
So we learned in the written testimony, we still don't really know exactly what he's going to say from this long, lengthy written testimony that we saw this afternoon. But what we know is that he is going to blame the middlemen, which is sort of the U.S. pharma CEO playbook. You know, we've heard this before from him. It's a similar argument. Blaming the U.S. healthcare system.
It's just incredible because now you have pharmacy benefit managers. You can count among their enemies the FTC, Mark Cuban, and also now the CEO of Novo Nordisk. He's kind of finding common enemies, isn't he?
Yeah. It's definitely the hot topic right now, and the blame is coming down on PBMs. This is something that U.S. pharma CEOs and pharma companies have been talking about for a while, and now obviously others are taking note as well and sort of joining in. But there are, lots of arguments to be made in terms of Novo is going to talk about the billions of dollars that they've put into developing these drugs, the research and development and production costs, and the fact that Novo's been at this for 3 decades. These are all things that are going to come up tomorrow. But as my colleague Robert Langreth reported this morning, looking at the R&D costs, Novo's already recouped 3 decades or 2 decades of R&D costs from the sales of Ozempic and Wegovy, which is just extremely fast. These drugs are extremely profitable, so it sort of undermines that argument a little bit.
The more they wind up having the drugs approved for other stuff, like heart issues or diabetes or other things, just not just weight loss, for example, does that change any of this calculus?
I mean, Novo will argue that these drugs, can be used for so much potentially, that they're so valuable, and that value sort of needs to be taken into account when we're talking about the price of these drugs. Is obviously the value that they have to the U.S. healthcare system and the value of the drugs themselves in treating potentially multiple different related and unrelated illnesses. And so that's something that they will talk about.
It's interesting. This is a company that's not based in the United States, but of course has a massive impact on American consumers as well. Can you explain a little more about how this really stacks up against American competitors and whether this kind of ties into the national discourse on what's made here and what's made abroad?
Yeah, I mean, it's interesting because really, as we've talked about, their main competitor is a U.S. pharmaceutical company, Eli Lilly, and they are the two in this market right now. And so there are lots of other companies that are trying to make weight loss drugs because we've seen how enormously popular and profitable they are. But right now, when it comes to competition, it's really, an American company, Eli Lilly, versus a Danish company. And interestingly, huge portion of Novo's sales are here in the U.S. The U.S. is such an incredibly important market for them. They also invest a lot in production in the U.S., so a lot of their drugs and their supply chain is here in the U.S., which is interesting too. And so it's just, it's an interesting dynamic to look at that.
Jobs versus profit. We're going to dig into this more. Bloomberg's Madison Muller, thank you very much for your time. Good luck covering all of this tomorrow. We're going to get more insight on the broader pharma sector from Jared Holz, Managing Director at Mizuho. You look at how much the GLP-1 conversation has stolen the room in the world of pharma. Is there anything else you're covering, frankly, right now?
this has been by far the most topical arena within pharma and really all of healthcare for 2+ years now. I don't really think there's anything close, just given the market size, the population, the fact that at the end of the day, this is a consumer product just as it is a therapeutic. So I'd say probably nothing close to this within the entire sector.
There's so much promise with these drugs. At the end of the day, you look at concerns already coming up within the government about what they cost. How much of a risk here does that concern really create?
I'm not really concerned about pricing as a risk near term. I think anytime you have a market like this that's under so much intensity from a competitive standpoint, and we're already looking at Novo Nordisk drug facing pricing pressure as a result of the IRA in 2027. So I think these are things that are going to creep up. Not that concerned about tomorrow necessarily as far as what the government is going to say. I think the investment base knows most of these risks. But yeah, I mean, long term, I think pricing and competition are always things we kind of look at.
I take a look at a year normalized chart of Eli Lilly and Novo Nordisk, and Eli Lilly has been really making a nice run here and been outperforming since July. Is Novo losing that first mover advantage thing?
I don't really think so. I think some of it is probably just the investor base that's willing to put money into either of these stocks and, looking at near-term catalysts and, the extent of earnings beats and things like that. I think they're both, it's kind of 1A and 1B to me in healthcare. Like these are the most looked at names, I believe, that we kind of consider within healthcare on a day-to-day basis. I'm not really sure why there's been such a lag over the last 6 months. Over the last couple of weeks, there have been some pipeline issues at Novo Nordisk and other situations, but they've both been excellent.
What other companies are kind of getting up to speed on GLP-1s that we need to start looking in that comp chart?
So Amgen's probably third or potentially third. They've got a big catalyst coming here by year end. They're looking at about a dozen different arms of their weight loss drug to see which doses and over which duration give patients the best efficacy, and obviously safety and tolerability are very important. But I think as we look forward here over the next 3 to 6 months, Amgen could wind up emerging as the third obesity player. There's also Viking Therapeutics, Structure in biotech, and then Pfizer's working on an oral as well that they're kind of investigating the doses that they're going to use.
I think I'm interested in asking about Pfizer as well, because Pfizer is such a giant in the room of pharma, and what they haven't built, they bought. And so how much do they need it? Do you think that these large pharma companies that see the potential of GLP-1 elsewhere catch up because they really need to at this juncture?
I think they all kind of need it. I mean, this will be the biggest market in all of pharma and or biotech within the next 2 years. And it will undeniably be $100 billion by the end of the decade, even with a lot of price concessions or pricing pressure on the group, just given the population and the cost of the drug. So I believe Pfizer does need it. They're working on it behind the scenes. They're looking at a range of doses for an oral therapy. Right now, all we have are injectables, but Roche is also kind of in the arena. I'd be surprised if other pharmas didn't get in here vis-a-vis M&A at some point.
I want to go back a little bit and talk about kind of this argument that the Novo Nordisk CEO is making to Congress here. This idea that you should just blame the middlemen, blame the pharmacy benefit managers. I've been trying to untangle this in my head for a long time.
It's a congressional hearing, man. Why bother?
Well, but this pharmacy benefit manager chain of rebates and getting the item to customers is very confusing in terms of how the economics work across all drugs, really. And at the end of the day, what does it mean if that system were to be disrupted for a company like Novo Nordisk or Lilly?
Well, I think the same argument that is going to be used tomorrow is the same argument that pharma has been using for decades, which is to say that the supply chain or the middlemen that are associated with these transactions getting drugs to patients are why the price is so high, because there's so many other parties that take profit along the way. So I don't think anything that's going to be said tomorrow is going to come across as novel. And I think the Senate and other members of Congress have been hearing this for years as well. That's why there's pressure on those type of businesses. But I don't think anything tomorrow is unique to these weight loss drugs. I think it's unique insofar as the population and the size of the market in the out years is just tremendous.
All right, Jared, really appreciate it. Thank you so much, Jared Holz over at Mizuho, joining us on what's going to happen on Capitol Hill tomorrow with Novo Nordisk and Bernie Sanders, basically. All right, coming up, top three, where we focus in on the top three movers and shakers, the center of the day's biggest stories. That's next. This is The Close on Bloomberg. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. First up, Gina Raimondo, the U.S. Commerce Secretary. She is behind the new Biden administration proposal that would block the sale of an import of Chinese and Russian-made hardware and software for connected vehicles. The goal of the ban would be to bolster U.S. security from hacking threats. And Shonali, it doesn't just stop here. It actually goes to other places, too. I was in a meeting earlier talking about how AI is going to become really localized and regionalized and making sure that the data is not going to be shared with other countries or even other states, for example, and how this is just the way that we're going here with technology.
National security in the vein of commerce is really the name of the game. Gina Raimondo, by the way, is a consistently floated member of a future cabinet if Harris were to win, maybe even Treasury Secretary. I mean, she is a name to absolutely watch, and her way of handling kind of these key election concerns, I think, is going to put her increasingly on the map for the next couple of months.
Yeah, talk about handling difficult situations. What are you watching?
Yes, actually, another very difficult situation. I'm watching Andrea Orchel, who is the CEO of UniCredit. The lender has moved to more than double its stake in Commerzbank and has become its largest shareholder ahead of the German government. And it's signaling that UniCredit is on the course for a takeover. Remember, this is something that the German government does not really want, to say the least. And they have been working with Andrea Orchel. Remember, this was the top deal maker at UBS that went to try to go lead Santander and then got into a big legal dispute, not shy of legal disputes to get the tough job done. He's been working with Barclays and Bank of America to quietly build up that Commerzbank stake, according to Bloomberg's reporting.
Here's what I don't understand. So they have 9%. They're petitioning to get over 12%, right? Because you can't own more than a certain amount. Like, the fact that he wouldn't have talked to someone in the government astounds me, particularly if it's like making some kind of an official takeover talk. Like, really? Did they not talk to a government?
If I know anything about Andrea, he's probably lawyered up well on this if he didn't have those discussions. So,
Yeah.
you know, art of war was the first thing he ever taught me. So
there, exactly. So there you go.
Him.
But I remember the idea of like, oh, it's going to be more Italian than German. I don't really know what
Hard
that
to
means.
see.
But there we go. All right, third up, I'm watching Asia Wilson after the Las Vegas Aces player was named the 2024 WNBA MVP, becoming the second player ever to win the award unanimously. Honorable mention of the night is Indiana Fever's Caitlin Clark, who was named AP's Rookie of the Year, also unanimously. But let's be honest, this is all about women crushing it right now in sports.
Absolutely, and basketball has been a really exciting arena for that. I would put women's football or soccer, rather, to be part of that group. But these two women have stolen the show in such a massive way, and money comes along with it. Not only investment in the sports, but investment in sponsorship. So a lot more to go as they win these awards.
Right, but isn't their whole like their likeness image has been really like, oh, it's supposed to be really good for players, but then maybe it's not, and they're not being handled well, or
I love talking to you about NIL.
Because you're like, oh, finally, I can know more.
Well, more to come on that.
NIL,
name, image, likeness.
Okay.
That's what gets you into college sports in a bigger way with all that big money. Now, we're going to switch gears from NIL and Alex and her sports foray. We're going to talk about the AI race that's continuing to heat up across the globe. We're going to break down what it means for America's infrastructure to make sure the U.S. stays #1.
Oh, I got this. I got this one.
AI is here to stay, and the country has to be successful in AI from a geopolitical security perspective as well as an economic perspective. Number two, the climate crisis, although we may change our focus over a period of time, is going to be something that we are going to have to deal with as humanity.
That was Constellation Energy CEO Joe Dominguez talking to Bloomberg's Katie Greifeld earlier about how AI is creating new needs for energy that our country hasn't experienced before. And that was a deal that was announced on Friday. We broke the story of Microsoft investing about $1.6 billion with Constellation Energy to revamp their nuclear 3 Mile Island.
It's fascinating. I want to look at some of the stocks that are also associated with this that are not Constellation, which was flying on the heels of that announcement. Take a look at Vistra Energy since that announcement from Microsoft that it would use nuclear energy, as we've been talking about. Vistra has been up, I think, almost 16% on Friday, another 3% today. NRG was down, maybe competitive pressure on the heels of this, but up another 6% today. We're going to bring in the reporter who had helped really report this out on Friday and follow through with the Constellation CEO today. We're going to talk to Bloomberg's Will Wade to talk about the nuclear space because you see it in the reaction. Look at that, 22% for Vistra over just 3 days. Clearly, the market is hoping for more nuclear energy, frankly, into the AI space. But of course, there are complications, to say the least. Can you walk through what the expectation is here?
The market would take more nuclear power today if they could build it, but it takes a long time to build it. But you should look at the year-to-date returns. Constellation's up more than 100%. Vistra and Energy, they're all in like the top 10 of the S&P.
Vistra's the best performing stock on the S&P.
Incredible.
Constellation's the third.
Yeah.
Okay, to that point, what was interesting, though, is we can make a lot of hay about this deal. But in terms of the actual energy it's providing for a data center, how much is it actually versus how much, say, a Microsoft data center actually needs?
This reactor is not one of the biggest in the country. It's 837 megawatts. The new ones now are about 1.1 gigawatts, so quite a bit bigger. But it has it has the benefit of being something that you can turn on in a couple of years. The last time we built a brand new reactor, they were like years and years behind schedule and billions of dollars over budget. So being able to bring 3 Mile Island back online in just a couple of years is going to make a huge difference.
Where are the sources of capital going to come from? I think it's interesting to see Microsoft really have a partnership in this regard. How many more companies can do something like this? And do you expect other private capital providers as well to step up?
Well, the list of retired reactors that can come back online is really short. I did a story on that, and basically I found 3. And now there's 2 of them coming online. So NextEra owns the only other plant that could potentially be revived. And they told us a few months ago they've been getting a lot of inquiries, mainly from data centers who want the power as soon as they could possibly deliver it.
Do we think that all the data centers are going to actually be built based on the power ability we have in this country?
I think they're going to build as many data centers as they can find power for.
Right, so power is going to be the constraint.
It's one of the huge constraints, yeah. I mean, you have to find places to put them. These are big facilities, too.
Well, what does that mean in terms of other types of power sources that we may have to see these data centers, frankly, tap into? And really the push, I've heard as crazy as people looking to deregulate many parts of the grid to try to get us there. So, what will it take at the end of the day to really get that power to these centers?
I think one of the key issues is climate, because a few years ago we were hearing all about everyone with their climate goals, everyone wants to go green, and all of a sudden there's so much power demand that now the companies are saying we may have to push out our climate goals. And that's going to be an issue. We've done a couple of stories on how we were starting to see a transition away from gas, and now all of this new demand is going to keep gas plants in service longer. We're hearing about more new build for gas plants that we weren't hearing about before. I'm starting to hear people talk about delaying closure of coal plants that we thought were going to close.
Mm-hmm. Yeah, just talk to Germany about that. That's definitely in there. Hey, well, really appreciate it. Bloomberg's Will Wade joining us there. All right, let's stay with data centers and power. And another company in the space is AES. Now, the company sells renewable power to corporate customers. It has 2 very fast-growing utilities and has signed power purchase agreements with big tech companies like Google. However, the stock is underperforming some of its peers like Vistra as well as Constellation Energy. Joining us is the CEO, Andres Gluski, CEO of AES. Andres, good to see you.
Nice to be here.
You're in the same business as like a Constellation Energy. You just have different sources of power. So why the underperformance right now with the stock?
Well, I think right now there's been a very strong reaction for nuclear.
Mm-hmm.
And what the market has really rewarded is what's called independent power producers who have excess capacity. So some of the nukes, the first rise of Constellation, for example, was just recontracting nuclear power at higher prices to the data centers. So that's it. Now, what I feel very confident is that most of the data centers will be powered by renewable energy. So if you look at what's actually in the interconnection queue today, 95% is renewable. Not even 1% is new nuclear. So that's why there was a lot of excitement about bringing these on. But to put it in context, if they brought back all 3 of the nuclear reactors, that's maybe 4 gigawatts. You know, the country is building about 30 gigawatts of renewables a year. So I think it's, you know, you have to put this in context, and I don't think the market's quite digested that.
So you need both, but really the bulk will eventually lie on renewables. So what does your backlog look like, and what are the conversations that you're having right now?
Well, we're building about 3.5 gigawatts a year. We're signing about 5. So we have a backlog of almost 13 gigawatts. That means signed contracts that I have to deliver over the next 3 years. So yeah, there's definitely any project that you can get permitted and built on time, there's demand for.
You know, recently you had struck a deal with CDPQ as well, big Canadian fund, and we were talking a little earlier about the amount of investment that is needed, where it comes from. Where are you seeing private capital in particular step up to fund these projects?
Well, we've always had a strategy of partnering with people. So in the case of CDPQ, they own 30% of our Indiana utility. We brought them in for 30% of our Ohio utility. Now, both of these are bringing in data centers to their service territory. So they should be growing very rapidly, probably the 2 fastest growing utilities in the country. So having a partner like CDPQ, which is, you know, the pension fund manager of Quebec, with $300 billion of assets under management, really helps you to make sure that you have the funds available.
You know, at the end of the day, wondering, to Alex's point, how much of those conversations are predicated about over the AI revolution here? Does the new money coming in have to have the buzzword assigned to it?
Look, honestly, not really, because the States is having a reindustrialization. So, for example, in the case of Dayton, they're building an EV factory. They're building a battery factory. So you already had growth in the case of Dayton. Now, putting in 2 gigawatts of data centers will accelerate it even faster. So the States is having more of a reindustrialization, I think, than people realize.
When you take a look at renewables like wind and solar, for example, the big question becomes storage and reliability, which is why things like nuclear and natural gas and maybe even coal still are hot for those sectors, because they do provide storage and reliability. How are you solving for that in the projects that you're working on?
Look, we invented lithium-ion batteries for grid stability, and we spun it off as a company. We did a $7 billion IPO of Fluence. So look, it's really what are the natural resources that are available? Because you really can do it with batteries. You just need a whole lot more renewables.
Yeah.
You can do it with gas. I really see coal, it might be delaying in some cases the retirement, but nobody's going to build new coal in the States. And nuclear, as I said, nuclear is really going to come on in the 30s, new nuclear.
Right, it's going to take a while. So talk to me about a project you have with Amazon Web Services, AWS in California, that you're dealing with renewable and also storage to kind of solve for that reliability and storage problem.
Yes, this is the biggest solar plus energy storage project in the country. It's 2 gigawatts, so put it in dimension with the nuclear, for example. And it's very exciting. We are the biggest provider of energy to hyperscalers in the world. So we know that market well. And look, if you can provide them with the renewable energy, that's their first choice.
So how many more discussions are you having under the surface akin to what you have done with Amazon?
Well, a lot. We have a pipeline of 60 gigawatts of potential projects. Now, it's a question of how many you can build in a given year. So we should be getting to building around 5 gigawatts a year, to give you an idea. But a lot of this comes down to new ideas and creativity. So we did first hourly matched renewable energy long-term contracts. We're doing a lot of leading-edge technology. This particular project in California, it's being partially built by AI-enabled robots that we've designed and that we're going to bring on, because there's really an issue of how fast you can build these. And so you'll still need a lot of people to do this. It's just with the same number of people you're going to hire, you can do twice as much.
You know, you were talking about Dayton, Ohio a little earlier, wondering what kind of regions you're finding as the most promising as your next place to build. And I ask this for 2 reasons. One, what kind of government involvement could help you do that? Yes. And B, what kind of jobs can you create in those areas?
Well, today maybe somewhere between 500,000 and 800,000 people work in the renewable sector in the U.S. Most of that investment is in red districts and red states. So the build out is a huge job creator. Now, I think we have to differentiate. Look, the West is a great place to put, for example, training data centers that don't have to be interconnected to telecom hubs. You know, you have less of what's called the latency issue. If you want to have it actually not training AI, but interacting with your LLMs, you're going to want it in places like California, Ohio. You're going to want it in Virginia, et cetera. So what you're doing is different places. Now, one thing is interesting. The demand for electricity in the States is growing maybe 3% a year. It could go up to 5%. We've done that in the past. If you go back to the 60s, we were growing faster than that. We operate in countries where, like Vietnam, Panama, the demand is growing 10% a year. So it certainly can be done. But we have to think about efficiency as well. And even efficiency in the GPU chips.
Right,
you know,
so
right
they
now,
use less power.
That's exactly
in
it.
order to be produced, basically.
Well, not only
or also to run.
To run, and that's the very interesting thing, because you could cut down in half the amount of power that they need. That just means that it makes it cheaper, and you have more uses for it.
Before we let you go, based on the fact that you've been doing this for a long time and have the business models, you don't need to raise cash, et cetera, depending on who we get in the White House, if the IRA, the whole thing just goes away tomorrow, does that affect any of this backlog that you have?
The backlog, no.
Okay.
Future signings, yes. And here, I think what we have to be frank about, in the States, we have an industrial policy of putting tariffs, which makes solar panels and batteries more expensive in the States than outside. That's offset by the Inflation Reduction Act. So if you just had the tariffs and not the Inflation Reduction Act, that would make the States very uncompetitive for renewable power and data centers, et cetera. So, you know, either do away with both, but you can't just choose one.
That's such a good point.
Andres Gluski, CEO of AES. We thank you, of course, to speak to us here on Climate Week. Of course, it is very topical discussion, especially in the midst of this AI boom, Alex.
Yep. I'm heading out, so I have to pick up my kids. So Shonali's going to be taking over for the rest of the 20 minutes. Thank you very much. We appreciate that. Yeah, climate and sort of how it winds up on a political sense is going to be really fascinating. I like talking my book, obviously, but still. All right, let's take a look on where markets closed today. It was a whole lot of nothing, but yet the S&P closed at its 40th record high this year. The Russell 2000, small caps closing a little lower, but mid caps outperformed. If you look at the mid index, that outperformed the S&P, as did the equal weighted index. The SPW also outperformed the S&P. 2-year going nowhere, touch of selling on the long end. Crude kind of going nowhere here. You got the VIX going nowhere. You getting the theme here? Things going nowhere?
Going nowhere, but of course, maybe things will go somewhere this week. It's still only Monday after all, Alex.
40th record high for the S&P. All right, this is the close on Bloomberg.
And crypto has been climbing along U.S. equities following the Fed's jumbo interest rate cut. But Mara Holdings has its sight on another rapidly growing industry, that's AI and the data centers that it takes to power it. Here in studio with more on this, Fred Thiel, CEO of Mara Holdings. And it's interesting, Bitcoin alone, you know, for now at least, it's been very promising. We're back to $63,000 or more per Bitcoin. But at the end of the day, why do you think it's so necessary for the crypto industry to be looking outside of crypto alone?
Well, what's important for Bitcoin miners is that over time, the global hash rate will continue to grow, which will continue to impact profitability. And every 4 years, we have a halving, which also impacts our cost to mine, making it that much harder to mine. So if you look over the past 2 years, we had essentially a halving in 2023 because the global hash rate doubled just through growth. And then we had a halving in April of this year. So it's gotten 4 times more expensive for Bitcoin miners to mine. The cost of energy is not going to go any lower. So if Bitcoin miners want to change their business models, they have to find ways to either subsidize their costs and lower their cost to mine by providing additional services, or find different ways to generate revenues, or they have to transition into things like AI and supporting AI infrastructure.
Let's talk about the investor sentiment around this, because it's pretty fascinating. Your stock was up almost 600% last year. It's been down 31% this year in the wake of that halving, as you're saying. So at what point do investors start to believe in that miner to AI story?
I think the whole miner sector got hit at the beginning of this year. A combination of things. MicroStrategy went very long Bitcoin by buying Bitcoin. And then with the halving coming, obviously the profitability of miners was going to change. As the investment community starts looking at miners and their involvement in AI, we personally believe that the way to focus as a miner on AI is by providing infrastructure. So we build liquid cooling technology that doesn't use water. Why is that important? AI consumes huge amounts of water, scarcest resource on the planet. If they use our two-phase immersion technology, no need for water at all. So they're able to cool their infrastructure in a much more cost-effective way. We also believe that primarily the world of AI will be inference. So what you see today are hyperscalers building large language models, LLMs. Think of that as the brain. Inference is the questions that you ask the brain. And so most of the inference will not be humans asking questions of AI, it'll be machines. Think of a Tesla. There are 100 different computer systems in a Tesla asking questions to its systems all day long. Think about digital twins, the ones that run factories, the ones that fly airplanes. These are all AI-based systems that will be interacting with data at the edge. And that needs liquid cooling technology, and we think that's a huge opportunity for
What's it going to take to make that transition really convincing? At the end of the day, are you having conversations with a lot of the large companies that are behind this LLM transformation, like OpenAI, like Anthropic? What does your relationship look like with them?
So we're not focused on the LLMs. We're focused on inference, which are the people whose systems will be querying the LLMs. So think of it as people like Microsoft. Think of it as other people who have large data sets that they're using for business and operational model. Oil companies. The Middle East is a huge area of interest for us. We have an existing relationship with ADQ and the sovereign in UAE over this type of topic, and AI, we think, is a growing area there. But really, this will be a relationship based on data center builders, and we're already having commercial discussions. We've already sold liquid cooling technology in the early stages, and we think over the next 2 to 3 years, this will become a growing piece of our business.
How big is that pipeline of clients?
Let's just say that the typical data center of 100 megawatts would generate for us somewhere around $30 million of revenue. So every 100 megawatts, $30 million. Think of all the gigawatts being built. You can add the numbers. It's a pretty big pipeline.
Now, before I let you go, also, I want to be cognizant that you have both presidential candidates, Donald Trump and Kamala Harris, out in the United States this week, really expanding on their plans for the economy. And when you think about their plans, their crypto plans, we've heard mixed things. For example, of course, Donald Trump being very friendly to the crypto industry. Made in America, he wants it to be, for firms like yours to be expanding. Kamala Harris, we've heard from some crypto companies that they have engaged with her campaign. Have you?
So Bitcoin miners have not engaged with the Harris campaign. Now, that I believe is simply a position they're taking potentially regarding the energy use of Bitcoin miners. But the fact of the matter is they have engaged with the AI industry, and AI will consume much more energy than Bitcoin miners. We believe this is a legacy of the Biden administration's perspective on Bitcoin mining in the U.S. But what they seem to forget, but something that Donald Trump clearly gets, is the national security aspect of Bitcoin mining. If you have trillions of dollars going into investment vehicles that are based on Bitcoin, you need to ensure that those investment vehicles will be able to transact Bitcoin. And to do that, you have to ensure that they'll have access to the transaction processing of Bitcoin, which is what miners actually do. Miners process transactions. And if all the mining is offshore, controlled by companies who may not be aligned with the U.S., they could potentially block U.S. companies from transacting with Bitcoin. Think about the amount of money that sits at BlackRock today, that sits at Fidelity today, and imagine that all of a sudden being unable to be transacted because the U.S. decides that they don't want Bitcoin mining onshore, they push it all offshore, and the other countries decide, you know what, this is a way to get back at the U.S. for sanctions.
Fred, we're going to have to talk much more about this. Of course, it's going to be an issue for anyone in the crypto industry heading into the election. I'm sure much more will unfold. That is Fred Thiel, the CEO of Mara Holdings. Now, I want to bring you some breaking news as well. OpenAI's rival, Anthropic, has floated a $40 billion valuation in early talks about new funding. According to the information, that would be roughly doubling its valuation from a funding round closing earlier this year. Remember, OpenAI is also pending a deal that could raise as much as $7 billion at a valuation of $150 billion. Another sign of more private money going into the hands of large companies in the world of generative AI. Now, still ahead, what investors need to watch for tomorrow. Of course, it is still Monday, busy week ahead. Stick with us. This is Bloomberg. Now let's look ahead to what else we're watching tomorrow, because we still have more earnings. If you could believe it, before the market, we're going to hear from AutoZone, in a sector that, of course, many investors are keeping an eye on. And then at 9 a.m. Eastern, the UN General Assembly debate opens tomorrow under the theme, leaving no one behind, acting together for the advancement of peace, sustainable development, and human dignity for present and future generations. At 10 a.m., conference board consumer confidence data, and of course, that comes before more consumer data throughout the week, including real personal spending and jobless claims, and also personal consumption. And at 10 a.m., we're going to be watching closely also that Senate committee hearing on Novo Nordisk Wegovy Ozempic pricing. We have some hints of what that will look like, with the Novo Nordisk CEO in a prepared remark, of course, according to Bloomberg, saying that he blames it on the pharmacy benefit managers. I am obsessed with this story. But of course, I'm also obsessed with this market. A record high today. That does it for us. Let's see what the week brings. Balance of power up next. Have a great evening. This is Bloomberg.